The purpose of this video is to review for Exam 1. I'm going to give you some hints, information in general about what you might see on the exam in terms of concepts and problems. First, we'll start with general information about the exam. The exam covers chapters 1 through 4. It will be administered in person only and in the classroom that our class normally meets. There are 36 multiple choice questions and problems, and those questions and problems are fairly evenly distributed among the chapters. There's 36 questions and problems. If you divide that by 4, that's 9. That doesn't mean there's exactly 9 questions and problems per chapter. There might be 7 or 8 from one and a few more from another, but there are not 2 or 3 questions from one problem and 15 questions and problems from another. So they're fairly evenly distributed. The formula sheet will be provided to you. That formula sheet contains all the equations you need to answer any of the questions or solve any of the problems on the exam. If the equation is not on the formula sheet, it will be given to you on the exam. So you don't need to memorize any equations at all. One recommendation, very, very strong recommendation, is to manage your time well in terms of the exam. And one thing you should do with regard to managing your time is not spend too much time on any one question. You really shouldn't spend more than about, I say, 5 to 7 minutes on a question. Maybe a problem, but not any question. Once you narrow your answers down to maybe 2 and you can't decide between those 2, move on. Now make sure you go back to that question and answer it. First of all, make sure you put answers down on the Scantron for every question on the exam, because if you leave anything blank, of course, then it's marked incorrectly. But if you're stuck on a question where you've narrowed it down to 2 answers, mark those answers on the exam, on the sheet. You can write on the exam and then move on. And there's a couple things that might happen. First of all, you might find the answer in a question later in the exam. Sometimes I actually put answers to some of the questions in other questions. Now, don't look for that. Don't take your time to look for that, but you'll know if that happens. Second, other questions might actually help jog your mind as you're moving through the exam. And when you go back to the question that you're stuck on, all of a sudden you say, oh, that's easy, it's this one. If you do puzzles like crossword puzzles or Sudoku, you get stuck, you put it down for a couple hours or maybe even come back to it the next day, and all of a sudden you start working it like nothing ever happened. That happens. So the same thing does happen on exams. So again, make sure you don't spend too much time on any one question. You want to manage your time wisely. You want to make sure that if the easier questions turn out to be at the end of the exam, that you have plenty of time to read those easier questions. You will have plenty of time to finish the exam if you manage your time wisely. Okay, here's what you should bring with you to take the exam. First of all, pencils. Number 2, pencils are preferred because you're going to have to fill in a Scantron with your answers. And by the way, as far as the Scantron is concerned, as you'll see in a second, you will be given the Scantron. Only the answers that you put on the Scantron will be graded. We're not going to look at the exam itself. So regardless of what you circle on the exam paper, that doesn't count. What counts is what you put on the Scantron. Also bring a calculator. Remember, the calculator cannot be programmable or have graphing capabilities. If you're unsure whether the calculator you have is programmable or has graphing capabilities, look online. Look it up. If you have the owner's manual, you can tell, or look online to double check to make sure that you can use that calculator with the exam. Bring your USF student ID. And I'm emphasizing USF student ID. If you do not have your student ID, automatically 3 points will be deducted from your score on the exam. So if you don't have an ID or if you can't find it, make sure you go get one. get it replaced. Everybody should have a student ID. I'm not going to accept driver's licenses, military IDs, or anything like that. It has to be your USF student ID. This is a closed book exam. You cannot use your book, of course, if it's closed book, and you will not be able to use notes. What you will be provided is three things. You'll be provided the exam, you'll get a Scantron, so you don't have to bring your own Scantron, and you'll get the formula sheet. As I mentioned in the previous slide, that formula sheet will have all the equations you need to answer any of the questions or problems on the exam. If an equation is not on the formula sheet, it will be provided in the exam. And finally, make sure you know your section number. You've got to fill in your section number on the Scantron. If you do not fill in your section number correctly on the Scantron, you will lose points. You lose 1 point for not knowing your section number or not filling it in correctly. You also lose 1 point if you don't fill your name in correctly on the exam, or if you don't fill in your UID number. You've got to know your USF ID number to fill in on the exam. And if you don't fill it in correctly or don't fill it in at all, you're going to lose points on the exam. All right, so I've got the review set up or divided into two parts. The first part, I'm going to talk about the concept questions, or in general, the concepts that you might see on the exam. And then in the second part, we'll talk about the problems that you might see on the exam. So let's start with the concept questions, and let's start with Chapter 1. First of all, remember that the primary goal of the firm, not just finance people, it should be any area of the firm, marketing, management, accounting, should be to maximize value. And maximizing value means that the way we check or measure maximization of value is by looking at the stock price. If the firm's value is increasing, then the stock price should be increasing. So bottom line is that the senior leadership team should be making decisions that increase the value of the firm and therefore increase the stock price. And that's something, by the way, we're going to talk about throughout the remainder of the semester. Make sure you know the different forms of business organization we talked about, and specifically the three primary forms, which are proprietorship, partnership, and a corporation. Make sure you know the advantages and disadvantages of each. Remember, in general, partnerships and proprietorships are the same, except for partnerships have more owners. It has multiple owners, 2 or more owners, whereas a proprietorship is just one owner. Now, corporation is completely different from a proprietorship, but make sure you know what the difference is. The greatest number of businesses in the United States, and that is a question here. Remember, we discussed this, and that is proprietorships. Because the proprietorships are typically the smaller firms, much smaller firms. So they are the ones that might be worth, I don't know, tens of thousands, hundreds of thousands of dollars. They can be millions or even billions of dollars. There's no limit to the size of a proprietorship, but they're typically the smaller firms. On the other hand, the form of business organization that generates the most sales and income, that's the corporation. Because the corporations in general, or maybe I ought to say it this way, the larger firms, the largest firms in the United States typically are corporations. So the billion and trillion dollar firms that generate the most sales and income, those are corporations. So an agency problem, first of all, know what an agency problem is. And remember, an agency problem is the fact that, or can exist, if the decision makers of the firm are not the owners of the firm, and they make decisions that are in their best interest, not the best interest of the owners. And that typically happens in very, very large firms. corporations. If I, for example, own IBM stock, even if I own 100,000 shares of IBM stock, that's a very, very small portion of the overall amount of stock that exists for IBM. So I don't run the firm. I don't make decisions as the stockholder. That's the senior leadership's responsibility. So I put my faith in the senior leadership. They're my agents, and I put my faith in them that they're going to make the right decisions, meaning decisions that maximize the value of the firm. If they maximize their own self-interest that are against my self-interest, that's an agency problem. And the question about firms that are most likely to have agency problems, those are very, very large firms where the owners are not involved in the day-to-day operations, like the publicly traded firms, IBM, General Motors, AT&T, and so on. How can the chances of agency problems be reduced? Or mitigated, as we say, and we discuss this in class, and it's in the book. Remember, many firms nowadays, the larger firms, are requiring the executives, those who are in the C-suites, as we call it, to be owners of the firm. They have to buy large numbers of shares of the firm's stock. So if they make bad decisions or decisions that are not in the best interest of the other owners, the other stockholders, they're making decisions that are in their not in their best interest as well. So if they're harming you and I as the small individual stockholders, they're also harming themselves. Also, we can tie their compensation to how well the firm performs. And we can also remind the senior leadership, in other words, the decision makers, that if they make bad decisions, the value of the firm is under what it should be. It's what we call an undervalued firm, and those types of firms are prime for takeovers. And if a firm like that is taken over, the firm that takes over such a firm cleans house. And cleaning house in this case means you get rid of the dead wood or the bad decision makers, and that would be senior leadership. So those guys up in the C-suite would lose their job, their nice cushy jobs. Remember about multinational finance, that's companies that deal not just domestically but also internationally. And typically there are differences between like firms, like size firms in the United States and foreign firms. And if you remember, U.S. firms are typically considered more open, meaning that generally the ownership structure is more dispersed. There's more owners, more stockholders, compared to similar sized firms in Europe and Asia. And that's just the nature of the beast, the way things have evolved over time in the different countries. Know some of the differences for going international, like seeking out new markets, raw materials, technology, to some degree technology, because technology really is available all over the world. So you really don't have to go global to get technology. Maybe efficiency in labor cost and things like that. But there's a list at the end of the chapter. You can take a quick look at that so you understand why firms typically do go international. Before we go on to Chapter 2, I've got a couple of questions here. You can see the first one on the screen. It says, in which type of business organizations do owners have limited personal liabilities for the firm's debt? Remember, proprietorships and partnerships, firms, the owners have unlimited personal liability. So the answer to this is corporations. So just to be clear, up here, let me change the color of my pen here. Up here, the proprietorships and partnerships, this is unlimited personal liability, meaning that any of the debt of the firm is the debt of the owners as well. So if the firm goes bankrupt and owes money after all the business assets are sold, then the owners have to actually liquidate their own assets like houses, cars, artwork, and so on to pay the business debt. In which of the types of businesses listed below is the probability of an agency problem or agency problems in general existing the greatest? And remember, we talked about it in the previous slide. The larger the firm, the more owners, especially the more dispersed those owners are, the greater the possibility of an agency problem. So the answer here is the last one, and that is a corporation with 1 million owners. And remember, we discussed this in class as well. A proprietorship cannot, let me repeat that, cannot have an agency problem. And that's because there's only one owner, and that owner is the person who runs the firm. Now remember, when we talk about agency problems, that doesn't mean that the decisions that are being made are necessarily always good decisions, but they're decisions that are being made in the best interest of the owners. At least we think they are. The example I gave in class was if a proprietor closes up their business and goes around the world fishing for a year and then comes back and finds that there is no business left because all the customers went to other businesses. That was a bad business decision, but that wasn't an agency issue because the proprietor did what they thought was appropriate and what was in their best interest. It was just a bad business decision. So be careful when we talk about agency problems. It's when the agents or the decision makers are making decisions they believe are in their best interest, but they are not in the best interest of the actual owners. Okay, so Chapter 2 deals with, remember, it's financial statement analysis. So financial statements as well as ratio analysis. So what you want to do, first of all, don't memorize any equations or formulas. Again, they'll all be on the formula sheet. I realize the formula sheet does not have all the ratios that are contained in Chapter 2, but as I stated earlier, if it's not on the formula sheet, it will be given to you with the question or in the exam itself. So you'll have all the information you need to answer or to solve the problems. So make sure you know what information is provided by the financial statements. For example, remember, the balance sheet gives an indication of the assets and the liabilities and the equity of the firm. Another word for the assets is the investments of the firm. And the liabilities and the equity provide, well, those are the sources of the funding of those investments. So when you look at a balance sheet, you know what the total value of the assets of the firm are, or is, I should say, and how those assets or investments are financed. And in this case, we know what percentage of the firm is financed with debt. That's the liabilities, and what percentage is financed with stock or equity. So make sure you go through and look to see what information is provided with each of the 4 financial statements we discussed in Chapter 2. And the 4 statements are the balance sheet, the income statement, statement of cash flows, and the statement of retained earnings. Also make sure you understand about sources and uses of funds. I have on the next slide, I have a question about that, so I'll defer that any further discussion until that question. Make sure you also know what information is provided by each category of the financial ratios. Remember, there's 5 categories, and those categories are liquidity ratios, asset management ratios, the debt management ratios, profitability ratios, and the market value ratios. To give you an indication, remember the liquidity ratios provide information about how well the firm is able to pay its current obligations, which includes things like accounts payable, which are what it owes its suppliers, notes payable, which are short-term loans owed to the bank, and so on, even salaries. Whereas if we jump down to the bottom, the last category I mentioned, which is the market value ratios, remember that gives an indication of what the investors think about the future prospects of the firm, because we see ratios such as the price earnings ratio, which is the market price of the stock divided by the earnings per share. Remember, the market price is established by the investors. So the investors like what's going on in the firm or what they expect to continue with the firm. They'll put a high price on the stock price and vice versa. Remember that when we conduct ratio analysis, we've got to do two general types of analyses. One is trend analysis and the other is comparative analysis. Remember, the comparative analysis basically says, gives an indication where the firm is right now. How does it compare to other similar firms? And typically the comparison is made by the industry in which the firm operates. So if I was evaluating Ford Motor Company, I would say, okay, how does Ford Motor compare to the other companies in automobile manufacturing industry? Is it in the upper echelon or the upper portion of its financial strength or the lower portion today? But also remember, we want to do a trend analysis because we want to know how the firm got to where it is today. Did it get there because it's been improving over the past 3 to 5 years? Its financial position's been improving. Or did it get there because its financial position is deteriorating over the last 3 to 5 years? Remember, that's going to help us to form conclusions about the future direction of the firm. If the firm's financial position's been improving over the last 3 to 5 years, then I might expect it's going to continue in the next 3 to 5 years, and in that case, it might be a good investment. But even if the firm is in a good financial position right now, if its financial position has deteriorated, let's say over the last 3 years, and I expect that to continue, then that would not be considered a good investment because I would probably conclude the firm's financial position will deteriorate over the next 2 to 3 years. The most important input into ratio analysis, as we discussed, is judgment, interpreting the ratios. So the interpretation of the ratios and the meaning of those ratios really is what's important, because you want to form an opinion about what direction you feel the firm is headed. The primary reason for conducting financial statement analysis is exactly that, and that is it's all about the future. It's forming your forecast or your opinions about what direction you expect the firm is headed in the next few years, especially those years that you as an investor might be interested in investing in the company. There are certain caveats or issues that we should be aware of, and we discuss these. This is towards the end of the chapter. Things like there's multiple methods that can be used, multiple accounting methods that can be used to measure the same event, like LIFO versus FIFO in inventory accounting, or inventory valuation, I should say, or accelerated depreciation versus straight line depreciation when we're measuring the value, the devaluation of assets, and so forth. Inflation, mega companies that have multiple divisions that are in different industries and so forth. So you got to be aware of those when you're conducting the analysis. As I mentioned earlier, do not memorize equations. All the equations will be given to you on a formula sheet, and as it says here, all the formulas you need to solve the problems are contained on the formula sheet, or they will be provided to you on the exam. You'll be wasting your time if you memorize anything really for the exam, especially if you memorize formulas. So a few questions from Chapter 2 to just think about and answer. I pretty much answered this question. Which financial statement shows how the firm's investments are financed? And if you remember on the previous slide, what I told you was that the investments of the firm are the assets of the firm. Okay, so once you see that we're talking about the assets, it should be pretty clear that it's the balance sheet, because the balance sheet shows the assets on one side, and on the other side it shows the liabilities and the equity. And remember, the liabilities represent debt and the equity is stock. So that is how the firm actually is financed. Second question, the primary purpose for conducting ratio or financial statement analysis is too, and I also answered this question. Remember, it's all about the future. It's not to determine the firm's current financial position. Yeah, I want to know that, but that's not the primary purpose. I want to know where the firm is now to predict where the firm is going in the future. It's not to determine how the firm's financial position has changed during the past 3 to 5 years. Again, yeah, I want to know that because I want to know which direction the firm is headed, but that's not the primary purpose. It's not to compute the tax liability of the firm. It's not to determine the current market value of the firm. You know, I really don't care that much about what the current market value is, except if I'm going to actually, or I'm thinking about investing in the firm, that's what I'm going to have to pay. But that value is really the starting point. Do I think the value is going to increase or it's going to decrease? And that's what financial statement analysis is used for, is to help forecast the firm's future financial position, because that's how I make my decisions. If I think the firm is going to deteriorate, I'm going to stay away from it as an investor. If I'm a manager and I think the firm's financial health is going to deteriorate, then I want to figure out how to solve that, how to fix the problem and prop up the firm and even reverse the deterioration. So again, it's all about the future. Actually, all the decisions we make in business, not just finance, but in business in general, they are decisions about the future because they're decisions that we're going to implement tomorrow or the next day or whenever it is. Couple more questions from Chapter 2. First of all, this one deals with sources and uses. This one's asking which of the actions is a source of funds. So let me remind you what I recommended in class, that what you do is this. First of all, just think about one of the 3 items on the balance sheet, because really what we're looking at is changes in the value of balance sheet accounts, whether they're assets, liabilities, or equity. Those are the 3 items: assets, liability, equity. And the one that you can think about is assets. And we're looking for a source here, how does the change in the value of an asset produce cash or produce funds? And if you think about it, if it's an asset, I'm just going to write it in here. I'm going to have to erase this in just a second. But if it's an asset, if an asset decreases in value, then that means we sell the asset. So I'll write that out to the right here. And you're selling an asset that generates funds. Now that means the opposite. This is one side of the balance sheet. On the other side of the balance sheet, I'll even put it over here like so. I'm going to abbreviate and put a liability then has to be the opposite to generate funds. That means a liability would have to increase. And remember, liability is a debt. And if a debt increases, then what you do is this would be an increase in a loan. Or at least that would be one possibility. So if a firm gets another loan or increases the amount that it has borrowed, then that's going to bring funds into the firm. The same thing for equity. I'm just going to put EQ here for equity. If there's an increase in an equity, that would be like the firm selling stock. And that would bring in funds to the firm. So what you can do is use this information, and again, really what I started with was right here. That's all you need, is to start with assets. So if you start with assets, you can answer the question very easily here. Accounts receivable decreases, well, that turns out to be the correct answer in this case. But let's take a look at while I'm erasing. Well, I'll erase this in a second because we need it. Accounts payable decreases. Well, the only way accounts payable could decrease, remember, that's what you owe to suppliers, is if you pay off the suppliers. That's an outflow of funds, not an inflow. That's a use of funds. Common equity decreases. Well, if common equity decreases, that's like paying off debt. But in this case, it's repurchasing your stock. That takes cash or takes funds. So that's a use of funds. Plant and equipment increases. Well, if an asset increases in value, that means you bought more. So if you buy an asset, that requires funds. So the other 3 that you see listed here are all uses of funds, not sources. So let me go ahead and erase this because I need the bottom portion of the slide here for another question. But as I'm doing this, my suggestion is you just use assets, depending on whether you're asked about a source or a use of funds. If it's a source of funds, then think about what has to happen to assets for an asset to produce funds, and that would be to sell an asset, which means a reduction in an asset. And the opposite would be the case for a use of funds with regard to an asset. And you can see that down here at the bottom. This plant and equipment is an asset, and if it increases in value, that means you bought more of it. All right, so the final question here says blank is probably the most important input to successful financial statement analysis. And just to go through these things, computing the ratios is not the correct answer because it's really easy to compute a ratio. It's one number over another number. Determining which ratios to use, very, very easy. Finding a benchmark is simple as well. You just get online and say, if I'm using or evaluating Ford Motor Company, what are some of the ratios, or what are the ratios for the automobile industry, automobile manufacturing industry to be specific. So it's really the interpretation of the ratios. As I mentioned earlier, it's the judgment you have to use to interpret ratios. All right, for Chapter 3, remember, was titled Financial Markets and Institutions. So we first talked about the financial markets and then the institutions that are participants in that market. First of all, the primary role of the financial markets, remember, is to facilitate the flow of funds. And the flow of funds really, as we discussed, is that we're talking about those who have excess funds, those funds flowing to those who need funds. In other words, the investors' funds flowing to borrowers. And that's exactly what the financial markets do. They help to facilitate that, make things much more efficient. The different types of financial markets, I have a question in a little bit about that, but what I'm talking about here is things like the money market versus the capital market. Remember, the money market is a short-term market, and that is where the original the original maturity, for a particular type of investment is less than 1 year, a year or less, whereas the capital market are long term. So remember, the capital market can only be equity, can only be stock, because stocks do not have maturity, and therefore it would have to be stocks. The money market can only be debt. More specifically, only debt that has a maturity of a year, or an original maturity, as we state, of a year or less. Original maturity means when the debt was issued. But it has to be debt in the money market because only debt, compared to equity or stock, only debt has a maturity. The efficiency of the markets, primarily think about the information efficiency. Remember, there were three types or degrees of efficiency, we called them. The weak form efficiency. Remember, that is where the prices of instruments like stocks include all historical information. The semi-strong form efficiency. Now we're talking about all publicly available information, which is not just historical information, but also when announcements are made. When private information becomes public, that's an announcement. And when that happens, if there's a very quick reaction to the announcements information, then we're probably semi-strong form. The strong form includes all information, both public information and private information, which is inside information. And we clearly are not strong form efficient because we have rules, we have laws against trading on inside information. So just make sure you understand the different types of, or the degrees of efficiency. And basically what they're saying is that you can't use information, certain amounts of information, to earn what we call consistent abnormal returns. Remember, an abnormal return is a return that's greater than what you should be earning for the risk you're taking. And the key really is that you have methods that you could use to consistently earn abnormal returns. Everybody can earn abnormal returns, but in most cases, well, actually, if the markets are efficient, in every case, it should be due to luck more than anything, that you don't have a technique that you can use that allows you to consistently pick the winners, so to speak. Okay, investment banking house. Remember that investment banking houses, they don't have anything to do with banking, even though banking is in their title. They help firms issue, I should say help firms raise, which is issue, raise funds. Right? So they help firms raise funds by helping them to issue stocks, bonds, or both. So their primary job is to help firms to raise funds. They're the experts in the marketplace. They don't take deposits and make loans like banks do. So they really don't have anything to do with banking in general. The types of financial intermediaries. Now that's a bank. That's a commercial bank, a credit union, savings and loan. Make sure you read in the textbook the different types of financial intermediaries and the reasons that they exist, the reason they were originally formed. In many cases, it's very interesting why they originally were formed. The intermediaries in the United States are more heavily regulated than intermediaries in foreign countries. And that's primarily because of the way things were set up originally in the United States. We're getting closer. Well, I guess as I mentioned in class, deregulation has been around for about 40 years plus, since the early 80s. And the deregulation in the United States is primarily to help our firms in the United States, our banks in the United States compete better with international banks. We now have more banks in the top 25 than we have had in decades. So it's helping. We actually do have more independent financial intermediaries, more banks, credit unions, savings and loan in the United States than other countries. In fact, we have significantly more. We have 5,000 or 6,000. Other countries might have hundreds, if they're lucky. The size of our financial intermediaries, our banks in the United States, are smaller in general compared to those in other countries. Remember, the top 4 banks currently are from China. We actually do have 2 in the top 6 right now, but next year or in 3 years, who knows? Our banks might be back down in the second 10 of the top banks in the world. The top, when I say top, I mean in terms of their size. So the U.S. does not dominate banking around the world. We're very competitive nowadays, but we're not the largest banks in the world. And again, it has to do with the regulation that has existed over the past century and a half or so in the United States. Okay, I have a few questions from Chapter 3. First of all, which types of financial assets are traded in the money market? And this is one of the questions we had when we went through the lecture. Remember, the answer here is only debt. Just to remind you, and I'll write it up here, this equity is stock, and equity has no maturity. In fact, when we get back to the Chapter 7 and we talk about stock, what we'll do is effectively assume the maturity of the stock is, I'll put it like this, is infinity. So it looks like so. Well, if you think about it, infinity is about as long as you can be. And remember, money market is short term. The original maturity of the instrument has to be 1 year or less. And in this case, the equity cannot qualify. So it can only be debt, and specifically, it can only be short-term debt. So if I ask the question about which assets are traded in the capital market rather than the money market, so in that case, the answer would be both debt and equity. Clearly, equity has no maturity, so it's long-term, as we said here, right? But at the same time, long-term debt Mortgages, for example, even automobile loans, long-term debt that when originated had maturities greater than a year, that those debts would be traded in the capital markets. So both debt and equity would be traded in the capital markets, but only debt in the money markets. And as it says on the screen here, specifically only short-term debt. Equities trade in, and if you go through the list here, you can go through and cross out if you want, where equity or stock is not traded. And I just mentioned it cannot be traded in the money market because it is a long-term instrument. So the correct answer here actually is in all three of these markets. Equity trades in the capital markets. Equity trades in the stock market because equity is stock. And equity also trades in the secondary market. Remember, the secondary market is the market where there is trading that exists among the different investors. So that means we're trading already outstanding stocks and bonds. Bonds trade in the secondary market. In fact, bonds can trade in all of the markets that you see boxed here, except for the stock market. It can trade in the capital market because bonds are generally, when they're issued, they're long-term. That would be a capital market transaction or trading or transaction. And they also trade in the secondary market, just like stock. Filling in the blank here, the form of market efficiency that states the current stock prices reflect all publicly available information. As I mentioned on the previous slide, that is the semi-strong form of market efficiency. All right, so Chapter 4, I've been saying over and over again, this is the most important chapter in the course, and that is true. Everything that we learn in this chapter, we're going to apply throughout the remainder of the semester. So please make sure you understand the concepts of the time value of money. First of all, interest compounding. Remember, interest compounding refers to the fact that interest earns interest. So if I invest a certain amount of money and I earn interest on that money, I leave the interest in the investment. Over time, that interest that is accumulating in the investment also earns interest. The example that we talked about in class is invest $2,000 today at 10%. If I earn 10% on that investment, then in the first year, I'm going to earn $200 interest. That's 10% of 2,000. So at the end of the first year, the amount that is in my investment will be $2,200. The original 2,000 plus the $200 in interest that was earned for the first year. Now, if I don't take that interest out of the investment, that means in the second year, 10% is earned on $2,200, and 10% of $2,200 is $220. Well, that means that I earned more interest in the second year because I left the $200 of interest that was paid in the first year in the investment, and that $200 earned 10% or $20 worth of interest. That is interest compounding. And as long as we leave the interest in the investment, the amount of interest earned every year or every period will grow. It will get larger and larger and larger. This is a correct statement. The red highlighted words line up with the red, each red highlighted word, I should say, lines up with each other, and the blue lines up. So I'll just give you an example. Let's say that we want $10,000 in 10 years, maybe, or 5 years, let's say. Let's make it easier and say in 5 years. So maybe you want to take a trip or something 5 years from today. So you want to invest a certain amount today, and that amount with interest will grow to the $10,000 in 5 years. So we'll accumulate interest and be equal to 10,000. So think about this. If you invest your money at, let's say, 8%, well, we can figure out how much the investment needs to be today to grow to $10,000 with interest in 5 years. That's pretty simple. We just compute the present value of the $10,000. But if someone else can only invest at 4%, that's half of the 8%, then that person is investing at a lower interest rate, and means that that person will earn lower interest during the 5-year period. So that person's got to start with a greater amount today to build up to, with interest, to the $10,000. So that's what the statement in red is saying. The lower the interest, the greater the amount you have to start with today. And of course, reversing things, we can see that the person who earns the higher rate, the 8%, would need to invest a lower amount today compared to the person who starts with, who earns a 4% rate per year. Make sure you understand the difference between an annuity due and an ordinary annuity. Remember, annuity due is the annuity payment is at the beginning of the period, and an ordinary annuity, the annuity payment is at the end of the period. So what this means, for no matter what the situation, it would be this. We talked about this in class. The future value of an annuity due is always, regardless of the amounts, is always greater than the future value of an ordinary annuity. And the same thing happens for the present value. The present value of an annuity due is always greater than the present value of an ordinary annuity. So make sure you understand that. You can actually plug numbers in and set up an example, which I'll show you when we get to the section where I show you some problems. The APR versus the effective rate. Remember, you'll always want to compare effective rates. The EAR stands for effective annual rate. That is the actual rate that you're earning on the investment. The APR is called the simple rate. It doesn't include the effects of compounding, whereas the effective annual rate takes into consideration the effects of compounding. So APR really is only used to determine the rate per period that you are paid in terms of interest. So for example, I'll put over here. What that means is the rate per period. Oops, the pen wasn't writing there, so here we go. The rate per period is just the APR divided by the number of interest periods during the year. In other words, the number of times interest is paid during the year. So what that means, for example, if you have 12% APR and you're paid interest monthly, 12 divided by 12 months in the year is 1%. So the amount of interest that you would be paid is 1% of the balance in your account each month. And that's exactly how we use APR. So I'll show you some examples of the APR when we get back to the problems as well. Amortized loan, remember, it's generally fixed payments, and there's two parts to the fixed payment. The interest owed on the outstanding balance is part of that fixed payment, and that goes down as more payments are made because the amount that you owe decreases, because the other part of the amortized loan payment is that the portion that pays a partial amount of what you owe on the outstanding balance. So for each payment you make on your amortized loan, you're actually paying off the loan. That means the amount that you owe goes down and down and down as you make more and more payments. Well, as you owe less on the loan, that means the interest that you pay goes down as well. So make sure you understand that, and you can bet that you will have a problem that deals with amortized loans. I will show you that when we get to the problem section of this review. All right, to wrap up this section of the review, the concept section, here are a couple of questions from Chapter 4. The first one, the payment on an amortized loan includes interest owed on the outstanding balance, plus, and we just talked about this, it's partial repayment of the amount owed on the loan. It doesn't include taxes and stuff like that. You can include taxes and insurance with it's technically a separate payment on the loan. It's an escrow payment. It's not really repaying the loan or anything like that. For an amortized loan, the two items that are included in the payment are the interest that you owe on the loan and the partial repayment of the amount that you still owe on the loan. Everything else equal, which of the following would cause the present value of a lump sum payment in the future to decrease? I recommend when you're answering questions like this, you simply make up an example for yourself. And what you can do is, this is a present value. You can say something like, here, I'll just give you one to use, for example. Let's say that you have a future value amount of, or you're aiming. Let's do what we were talking about earlier. The future value is $10,000. You want to put aside an amount today that will accumulate interest over a 5-year period. So I'm going to put n equals 5 in here. We're going to assume interest is paid annually to keep things simple here. So n equals 5, I/y. We'll start with, let's say, 4%, which is one of the rates that we talked about earlier. So 4% here. And the future value is 0 because, I'm sorry, not 0, the payment is 0 because there is no annuity here. So what you'd be solving for is the present value. And I'm just going to put a question mark here and not actually do the solution. But you should do the solution because what you can do is this. You can change the timing of the payment, which is the first scenario here. And that means what you would do is change this to 7 and see what the result is. And I can tell you what's going to happen there is that that is the actual answer, or one of the answers, I guess I should say here, because what's going to happen when you extend the time you have to build up to this $10,000, you don't need to start with the same amount. You start with a lower amount. Think about what if I needed the $10,000 in 50 years. Well, I got 50 years to build up a whole lot of interest, so that means the amount I start with today should be a whole lot less. All right, the second one says to increase the opportunity cost. Okay, so in that case, what I'm going to do is change maybe the 4% to 8%. Now, if I did that, by the way, I would go back to the 5% here, put everything back to where it was, and only change the I/y. So as we talked about earlier, if the amount of interest that I have the ability to earn increases, then, and everything else stays the same, then to get to the $10,000, I need to invest less today. So that means the present value is lower today because there's going to be more interest that's going to be earned. Okay. Now the last one is that the lump sum payment is increased, and that means that the amount that I want or need in the future is greater than $10,000. Well, if that goes up and the amount of time stays the same, the original amount of 5 years, and the rate stays the same, the original was 4%, then I'm going to need to start with a higher amount today. So the answer to the question here is actually both the timing of the payment is extended because if you have a longer time to build up interest, then you need to start with a lower amount, and the opportunity cost rate is increased because if you earn more interest over the same time, then you need to start with a lower amount as well. So if you have a concept question, something like this that doesn't give you a specific situation with numbers, you can make up your own and then just go through individually and change each of the numbers. Now, when you do it, you have to be careful, like I did here. You have to actually change the number back. For example, when I went from the 4% here to the 8% up here, I actually had to go back to the 5 years because I want to keep everything else the same as the original situation, except for the particular number that I'm changing, which in this case was the interest rate. All right, so now we'll go through examples of problems you might see on the exam. They won't be these, but these are similar to what you were assigned from the textbook. And as I mentioned over and over again, the problems on the exam are quite similar to those that you were assigned to work from the textbook. So you have a problem in front of you. I don't have all the words in here, but ROA stands for return on assets. Don't worry, on the exam it will be spelled out so that you don't have to remember that ROA is return on assets. But ROA is 5%, the debt ratio is 70%, and net income is 40,000. The question is, what are the firm's total liabilities? Remember that one of the suggestions I made is that you write when you have a ratio, write it out and then plug in the numbers you have. For example, ROA, the equation is net income divided by total assets. Again, on the formula sheet, it will not say NI, it will say net income, and TA will be spelled out as total assets. Well, we're given that value is 5%, which is 0.05. We're also given the net income. So you can see the only thing that's left to solve for in this equation is the total assets right here. So if we solve for the total assets, algebraically, you can see the result is $800,000. Now the debt ratio is total liabilities divided by total assets. So this gives us the percentage of the firm that is financed with debt. And in this case, that's 70%, or 0.7. We just computed total assets. So we know then that 70% of that $800,000 of total assets has to be financed with total liabilities. And that means the answer here to the question is that total liabilities equal $560,000. If you were asked to compute the owner's equity, you could do, actually you don't even have to take an extra step, you just do this. If liabilities or debt makes up 70% of the financing, then the remainder, or 30%, has to be in equity, and in this case that's $240,000. Or you could just say that that is equal to the $800,000 of total assets minus what we just computed, $560,000, and that would be the $240,000. All right, I've got a couple of problems set up for Chapter 3. First, situation where the firm issued. Now, make sure you read all of these problems, or all the questions actually, very carefully to make sure you're not reading into them. And don't read into them. I'm not trying to fool you on any of the questions. But in this case, it says a firm issues $5 million in new stock. So the firm actually already issued or plans to issue $5 million. The investment banker charges a 5% fee on the total amount issued, which means on the $5 million. Other costs associated with the raising these funds or the issue is $15,000. And the question is, how much of the $5 million does the firm actually get to use? Does it get to keep after paying the issuing costs? So the net proceeds are equal to the total amount of the issue minus the cost of issuing. So in this case, you can see that the firm issued $5 million. What's paid to the investment banker is the $5 million times the 5%, which is this number right here. And then $15,000 in additional costs are paid for lawyer fees, printing, or whatever. So if we put this together, the total amount of flotation costs is $265,000. $250,000 goes to the investment banker, and the remaining $15,000 goes to the lawyers or whatever the other costs are. So the net amount that the firm actually gets to use is $4.735 million. I want to emphasize, though, the $265,000 is the total amount of the issuing cost. That includes two things. What's paid to the investment banker, which in this case is $250,000, and any additional costs that are incurred, like lawyer fees, printing, and so forth, which in this case amount to $15,000. Here's the second problem I set up for Chapter 3. In this case, the firm's got to raise $2.6 million to stay in business. And what that means is the firm actually needs to walk away from the issue after paying all issuing costs with $2.6 million. The investment banker charges 5.5% of the total amount of the issue, and the other costs are $46,000. So the question is, how much stock, bonds, or both does the firm need to issue to actually net $2.6 million after paying flotation costs? It doesn't matter whether the firm's issuing stock, only bonds, or both. I don't care how many shares need to be issued. It's whatever the amount, the bottom line has to net out to $2.6 million for the firm to use. So in this case, the amount needed, or the net proceeds, is $2.6 million. The flotation cost stated as a decimal is 0.055, which is the 5.5%, and the other costs are $46,000. Now remember, this chapter only has one equation in it, and that's what I'm going to plug into. This is it. The amount that needs to be issued is, the numerator is the amount the firm needs, which is the net proceeds of $2.6 million, plus the $46,000 of other costs divided by 1 minus the flotation cost. And you can see the result comes out to be $2.8 million. That is the correct answer, but this is a situation where you can double check your answer to make sure it is correct. So what I'm going to do is exactly that. I'm going to compute how much the firm gets to keep out of the total of $2.8 million. And that's the check that I'm going to do here at the bottom. So the flotation cost, if the firm issues a total of $2.8 million in either stock or bonds or both, is, as you can see, $200,000. 5.5% of $2.8 million goes to the investment banker, and then another $46,000 goes to pay for lawyers, printers, and so on. So the amount that has to be paid to the investment banker in this case is $154,000, and the remaining $46,000 make up the $200,000. Subtracting the $200,000 from the $2.8 million, we get $2.6 million, which is exactly what the firm needs. So this shows me that the $2.8 million is the correct answer for this problem. For Chapter 4, I have a number of problems, and as you can imagine, same as what you were assigned from the chapter. The most problems that you've had assigned from any chapter is Chapter 4, so I have more problems as examples here. First, the question is, what's the effective rate of an investment that pays 11% compounded quarterly? All you have to do is plug into the appropriate equation, which in this case is over here, the one that is, this is the actual equation that you have on your formula sheet. And remember, when you're using formulas to solve problems, you have to translate the percentage into decimal form. So that's what the 0.11 is here, and M in this equation represents the number of times interest is paid during the year, and because it's quarterly interest, it's paid 4 times a year. So you can see the result, the answer to the problem question is 11.46%. Pretty simple computation. You just have to make sure that you plug into the formula correctly. Second is, if you invest $5,165 today at 3.6% compounded monthly, how much will your investment be worth in 4 years? Now, the most difficult part here is making sure that you make the adjustment for the fact that interest is paid monthly. Remember, we always want N to be the number of interest payments over the life of the investment. In this case, it's going to be 48. 4 years, 12 times a year, because interest is paid monthly. The interest is per period. The I/Y is per month in this case. So we took 3.6% divided by 12, and that's 0.3%. Then the present value, I put a negative in front of the 5,165 because it says you're investing 5,165 today, and that means you have to pay for it. Payment is 0 because there is no annuity here. So when you solve this problem, you get $5,963.69. Now remember, if you didn't put a negative in front of the present value, the 5,165, your answer would come out to be a negative 5,963.69. That's not a problem for the exam because, as I noted a couple times in class, you are not going to have selections that will be both positive and negative for the same amount. For example, for this particular problem, you will have a selection that, if this was a problem, you would have the selection of 5,963.69. You would not have another selection that said a negative 5,063.69. It would only be positive. All right, the next problem you see on your screen now says Christy invested $2,000 5 years ago. Her investment is now worth $3,221. And the question is, how much did she earn on that investment per year? And in this case, we're going to keep things simple where interest is compounded annually. Here's what you would put into your calculator. And as I recommended in class, and I continue to recommend, make the adjustment both for n and I/y all the time. In this case, even though interest is compounded annually, in this case, you can see what I did. I took 5 years times 1 time a year. If it was 12 payments a year, 12 interest payments a year, or compounded monthly interest, then I'd have to multiply 5 times 12. But if you get in the habit of doing this, you'll be in good shape with regard to answering the questions and the problems in this case. So I put in for present value a negative 2,000 because Christy invested $2,000, which was an outflow, meaning she paid for the investment. That's a negative. The payment is 0 because there is no annuity here, and the future value, Christy collected $3,221 5 years later. So doing the computation here, we get 10% as the result. Now remember that you've got to have one of these two values right here, either the present value or the future value has to be negative when you're doing this computation. If you don't put one of the signs as negative, either the present or future value, you're going to get an error. You're going to get that error 5 where the calculator is telling you that it doesn't understand what you want it to solve. Because if you have both the same signs, you're telling the calculator you either have 2 inflows and no outflow. That would be positive 2,000 and positive 3221, and the calculator would be telling you that's impossible. Or if you made both of those negative, then you'd have a negative 2,000 and a negative 3221, and you'd be telling the calculator that you paid out 2 amounts, one now and one in the future, and that is not possible either. So be careful to make sure you make one of the two, either the present value or the future value, a negative. The bottom line is the PV and the FV have to be opposite signs. In this problem, George plans to invest $5,000 at the beginning of each of the next 30 years. And that means the first $5,000 investment will be made today. If the investment's return is 3.9%, the question is, how much will his investment be worth in 30 years? Clearly, we're computing the future value of an annuity. So things look like this. The 30 years, n is equal to 30 years times 1 time a year, so n is 30. I/y, because interest is paid once a year, is 3.9 divided by 1. We are not computing the present value, so PV is equal to 0, and the payment is the annuity amount. And I put a negative in front of the 5,000 because it does say George plans to invest $5,000 each year, and that means George has to pay or make a cash outflow of $5,000 to put into the investment. And performing the computation, we get $275,786 as the amount that George would have in 30 years. Okay, so some of you are sitting there saying, wait a minute, that's not correct. And you're absolutely correct if you believe that is not the correct answer. And the reason is because what I gave you the answer to was the future value for an ordinary annuity, which would be the case where if George had made the $5,000 investments at the end of each year. Now, first of all, before even performing the computation here, you should know what the result is going to be relative to the 275,786, because if the investments are made at the beginning of the year rather than the end of the year, each of the $5,000 will earn 1 year's additional interest. So more interest will be earned on each of the $5,000 annuity investments. And that means the future value has to be greater than 275,786. So you can see the setup's exactly the same as for an ordinary annuity, but what you've got to do is flip the switch from ordinary annuity to annuity due. And on the Texas Instrument calculator, when you flip the switch, you see in the upper right corner of the display, it says BGN. So when you flip the switch and do the computation, the result is $286,582, and that is the correct answer. So you got to be careful on the exam, because I can tell you, remember, this is multiple choice. So I'll tell you that 2 of the answers are possible. 2 of your selections would be for this problem would be 275,786, which is the future value of the ordinary annuity, and 286,542, which is the future value of the annuity due. Both are correct answers, but only in terms of the actual computation, but only one is correct for the situation given here. And this is an annuity due, so the 286,584 is the correct answer. So anytime you're working an annuity problem, make sure you check, first of all, to determine whether it's an ordinary annuity or it's an annuity due, and then make sure you're doing the correct computation for the annuity that the problem states. Okay, just a few more problems. First of all, this one, Sammy's planning to take a vacation to Singapore, but not until 6 years from now. And the cost is expected to be $7,500. She wants to invest an amount today, a lump sum amount right now, and then leave it in the investment, in the savings account or whatever it is, for a total of 6 years. And then in 6 years, she wants that investment to be worth $7,500. So whatever she invests today plus the interest has to end up equaling $7,500 in 6 years. And the opportunity cost rate is 5.8% compounded quarterly. And so the question is, how much must she invest today? So very simply, here's the setup on your calculator. N is going to be 24, 6 years times 4 times a year, because interest is going to be paid quarterly, which means 4 times a year. The interest paid per period is 5 divided by 4, which, if I do the math correctly in my head, I think that's 1.45%. But whatever it is, that is I/Y. Payment is 0 because there is no annuity here, and the future value is $7,500 because that's what Sammy wants her investment to end up equaling. So doing the computations, the result is $5,309. Now notice I actually did put the future value as a positive amount, the $7,500, because Sammy wants that amount to be able to spend. She wants to receive that amount from her investment. And you can see the present value comes out to be a negative $5,309. And that makes sense because that's the amount that Sammy should invest today. In other words, pay for an investment that is going to earn 5.8% compounded quarterly, so that she has $7,500 in 6 years. All right, so here's an example of the problem I've been promising you will be on the exam, either this or the next slide, or maybe both, who knows. But it's a problem that deals with an amortized loan. In this case, you plan to buy a car later today. The cost of the car, all of which you're going to finance, is $34,888. The financing or the loan you're going to get is for 5 years, and the interest is 3.84%. That's the APR. So the first question is, what are your monthly payments? Here's the setup on the calculator. 5 years, N is 5 times 12 because it's 5 years and there are monthly payments. The I/Y is the 3.84 divided by 12. And I know that it's divided by 12 because there are monthly payments, which means the interest is computed on a monthly basis in terms of what is owed on the loan. The present value is the amount that is borrowed. That's the $34,888. I put it in as a positive because that's the amount that you would receive today. So that's an inflow to you. The future value is 0, and as we discussed in class, in reality, for an amortized loan, the value of the loan is 0 as soon as the last payment is made. So putting a 0 future value is actually correct in this case. We are computing the payment, so I have a question mark there, and when we do the computation, it's $640. That is a negative, of course, according to the way the computer or calculator does the computation, and it's a negative to you as well because that's how much would have to be paid each month. All right, I'm going to continue with the same problem, but in this case, I'm going to assume we know that the payment per month is $640, what we computed on the previous slide. And what I'm going to add to this is that you want to pay off the loan today. Now, if you read this carefully, and you should, it says 3 years ago you purchased a car that cost you $34,888, and you ended up getting a 5-year loan, and your monthly payment was $640. So now the question is, if you want to pay off the loan today, how much do you owe on that loan? How much would you have to write the check for to the bank? So here's the setup. Now remember, what we're saying in this case is that, probably should write it out here, the remaining payments, the remaining life of the loan. So I'll just say remaining life. Okay, so in this case, it was a 5-year loan to begin with, and 3 years of payments have been made. So the remaining life, of course, is pretty simple to do this, is the 5 years minus the 3 years. So there's 2 years of payments remaining. I'll just do it like this, 2 years remaining on the life of the loan. And that's what we remember. Each of those loan payments of $640 includes both the amount of interest that is owed on the loan, on the amount that the firm still, or you still owe on the loan, and a partial repayment of the loan. Well, there's 24 payments remaining on the life of the loan. In other words, 2 years, 12 payments a year. So if you're going to pay off the loan today, you don't want to pay the interest, the future interest on the loan, because you're not going to have the loan anymore. So what we're going to do is compute the present value of the $640 that remain, the number of payments. I'll say it this way, the present value of the 24 $640 payments that remain. We're going to take the interest out. And remember, we take interest out of a future amount by computing the present value. And each of these $640 payments is in the future. The first, or the next $640 is 1 month from today. The one after that is 2 months from today, and so on. Now I know the next payment is due 1 month from today, because right here, the very last sentence says that the last or most recent payment on the loan was made 2 days ago. So then the question is, when's the next payment due? Is it due today, or is it due in about a month? And if you just made the payment of $640 2 days ago, you don't have to make another payment today, which means this is not an annuity due. It would be an annuity due if you had to make the payment today. So the next $640 is due in about a month, 28 days or 29 days, whatever. And that's about a month, and that makes this an ordinary annuity. So I'm not going to flip the switch to BGN. Everything I have, everything you see on the screen right now is what I'm going to input into the calculator, and I'm not going to flip the switch. When I do the computation, I get $14,762.28. That is the correct answer. That comes out as a negative because I put the 640 as a positive in here, because I'd actually be saving $640 for the next 2 years, $640 each month for the next 2 years if I paid off the loan today, and the amount that I actually would have to write a check for would be a little bit less than $15,000, and that would be a cash outflow. So please make sure you're able to work a problem like this, both what was on the previous slide where you have to compute the monthly, in this case, monthly payment, and what was on this slide, which requires you to compute the amount that is owed with some time remaining on the loan, in this case 2 years remaining.